Hi, and welcome to our LinkedIn Live broadcast on the release of the ISM Report on Business. My name is Dan Zeiger. I'm a senior writer and copy editor for Inside Supply Management, which is Institute for Supply Management's member publication. We're happy that you're joining us today as we break down the Services PMI data for March. It's the day after the so-called Liberation Day in the Services PMI. Though it was an expansion, likely didn't relieve any of the tariff anxieties the market is feeling today. The PMI was down 2.7 points to 50.8%. Though business activity remained strong, employment took a hit and landed in contraction territory. 10 of the 18 industries grew, down from 14 the previous 2 months. So there's a lot to talk about, and I have a hunch a fair amount of it won't be directly related to the PMI data. That's just kind of the day it's been in the state of play right now, but we'll see where the discussion takes us as we bring in Steve Miller. He's the chair of the ISM Services Business Survey Committee. Hey, Steve, how you doing? And what stood out to you in March?
Doing great, Dan. Yeah. The employment and the new export orders were kind of the two that jumped out at me from such a significant change. One of the things I had mentioned in an earlier call is that the magnitude of the change in employment we hadn't seen anything that big from a drop since April of 2020, the second month of the pandemic. Yeah. Now, not in terms of actual labor reduction, but the breadth across industries of those thinking they'll be reducing versus growing and staying flat. So that one for me was really a big one. On the positive side, that business activities index and the commentary that supported it didn't seem like the barn is burning. It was more seemed like, and in the comments for employment as well, it more seemed like, you know what, a lot of uncertainty. Let's hold a bit. Let's slow down rehiring of people, go through additional reviews for who should be hired and how quickly we want to hire folks. Because, in the services industry, labor is such a big component of our cost of goods or cost of operations. There are only so many levers you can pull when you're reforecasting, your 3+9 for the rest of the year. And you're saying, well, this could be a 75% increase in everything from China, or it could be a 10% increase, or, but we're safe if we're in Mexico. No, we're not. It was just a lot of creativity, I'm sure, in the CFO's office over the last month.
Yeah. Well, let's talk a little bit more about the business activity. When I first saw the report, that definitely stood out to me. That was not a number that you would expect when you see all where the other indexes were going. Obviously, very strong month growth this month. Let me pull out my trusty chart here, 55.9%. That was a 1.5% increase compared to February. Is that kind of fool's gold, based on where the other indexes are going, or is there any indication that could, stay resilient in the coming months?
So, my crystal ball is cloudy as of yesterday.
Sure.
There wasn't anything in the commentary, Dan, that would tell us the services growth has stalled. It was really just around, I think it was 16 of the 18 industries said they had tariff concerns and what that impact would be to their businesses. And then we saw the exports, the new export orders, which when you think about reciprocal tariffs or concerns on the buying side from international locations, that was down. So if anything, that's a big risk. I'd say to the extent that global business or orders outside of the U.S. are important, or from a percentage basis, important to your company. That's kind of the big watch out. Otherwise, there wasn't anything in the commentary that supported the numbers that said we should be very concerned. It looked like good year-over-year growth, continued strength in business. And the one other caveat I would put out there, Dan, is that for those companies that have a significant level of business with the federal government, they had commentary that said projects are being canceled, reducing staffing that are related to those lines of business based on cuts that are being done in the federal government.
Sure. You alluded to this obviously when you gave your summary, but especially unemployment, we had talked about that being such a pleasant surprise in last month with its highest reading in quite a while, and in March it just went absolutely in the other direction. Can you elaborate a little bit more on what happened? And especially I was intrigued by your comment earlier, the swath of the decay a little bit, how it was across a lot of other industries. Maybe you can expand on that a little bit.
Yeah, we saw reductions in things like education, public administration, some in information, and those were being all attributed to cuts in Inflation Reduction Act, other federal spending. For really across the board, the other concerns are we're having to go through additional reviews before we're allowed to hire people. We're seeing attrition that are being delayed in rehiring. So all kind of normal belt tightening that happens when there's uncertainty around input costs and people are trying to manage their bottom line. It didn't look like wholesale reductions or reductions in force or involuntary separation activity. It was more kind of the level of cautiousness and risk management.
Yeah. You just alluded to this. We'll discuss it a little bit further because we discuss on these calls or these broadcasts month to month. We kind of talk about various industries. And I think, when the average person on the street thinks of the services sector, they think of restaurants or hotels or, repairmen, stuff like that. And, you mentioned a lot of industries that are, big in, public administration, education, healthcare, and social assistance. We discussed the impact a little bit more last month, but, obviously the news in the last few days about the impacts of cuts on federal budget, HHS. Let me slow down. CDC, NIH, FDA, drastic by any measure, really. Just discuss that, just in general, how big of, public services and administration is on the services sector and the kind of impact, that these kind of decisions will have.
Yeah, and even beyond that, where the cuts aren't being made, certainly in the news is pressure being placed on services firms to reduce their billing levels. Regardless of whether there's cancellation in programs or not. So I think that from, let's say, from a impacts for those cuts, some of it I think I would put in the same bucket as the tariff discussions over the last couple of months. There's an announcement that there's going to be a cut, and then there's a lawsuit saying, no, there's not going to be a cut. This could be months and months in figuring out what the real impacts are, and whether they're going to stick or whether they're just, more kind of Pollyanna. We found this, let's cheer that we think we're going to reduce it, and then find out that we really can't.
Yeah.
So I think, Dan, I would, this is a month of uncertainty. I think in a nutshell, that's what I would say.
Yeah. Well, let's get into a couple of more index readings. We'll lead off with prices and, stick a pin in new export orders. We'll discuss that in a little bit. You had mentioned it at the top of our broadcast, and we can elaborate on that particular index in a minute. But yeah, the prices, 60.9% was the index reading in March. That was actually down 1.7 points compared to February. But, with what could be coming in the future, if is that index staying close to 60%, would that be a victory or a relief of that if the index stays in that neighborhood, doesn't go higher?
I think so. I think that is a positive situation, especially given some of the activity in February and in March around buying ahead, where some purchasers are not able to get items because, it's I hate to say this every time we talk, Dan, but it's another run on toilet paper. The tariffs are going to happen, so let's go get the stuff that we're going to need to get, because it's much more than just price impact. It's supply chain disruption and potential disruption that happens as people figure out, hey, I'm not going to take the risk in the tariffs. You have to take the risk of the tariffs. Well, I'm not going to do that. You have to take it, between buyer and seller. And in the meantime, people consume the inventory that's available. And so that has a tendency to create price pressure. And we haven't seen that. We saw continuing increase, but we didn't see any kind of a spike there. So I went, go back and look at data and see what else is out there. And since we're in the Trump administration and tariffs seem to be a popular discussion point, I went back to 2018, where, strangely enough, we had 12 months in a row of the prices index at 60 or above, 60 to 63 kind of range, from December of 2017 to November of 2018. We saw tariffs being increased on China, on Canada, on Mexico, and on the EU. Not taxes, but tariffs. And we saw an inflation rate of 2.3, 2.4%. So when you look at all that together, I don't think that's a bad story, having several months in the very low 60s. Now, the other side of that is we have a Fed rate of 4.33% now versus the 1.5 that went up to 2.5 during 2018. And we have a projected federal budget deficit of $1.9 trillion this year versus, I think it was 700 billion or something like that in 2018. So there's a lot of different things. And kind of an aside on that is, I don't think there's any case to be made that we should be seeing rate cuts anytime soon. With the tariff pressure and supply of money being so important to whether we see inflation or not. If we do anything that allows us to inject more debt or more money flow into the system, I think it's inevitable that it'll be an immediate inflationary impact.
Right. And yeah, the new export orders was another rate of change that stood out in March. It was at 52.1% in February, decreased to 45.8% in March. That's a change of 6.3 points. I was reminded on Tuesday, Tim Fiore, our manufacturing chair, kind of hinted that it was a minor miracle that the manufacturing new export orders was only in very mild contraction at 49% in change, considering some of the friction that's been created lately between the U.S. and its North American trading partners. Did it seem like on the services side, exports didn't get that same level of relief?
Yeah, I think your ability to turn the throttle on labor versus having commitments around hard goods that are going into a production process, you have a little bit more flexibility there, and that may be why we're seeing that. On the management of companies and support services, and professional, scientific, and technical services and information, those three industries, we saw a lot of commentary starting earlier this year around a reduction in commitments from overseas. So I think all of the discussion early on and to where we are today has specifically impacted those industries and led to some of those changes in the numbers.
Yeah. While we're talking about industries, on these broadcasts from month to month, we spotlight a few, ones that had a good month and, ones that stood out. And, one that stood out to me in this month's report was construction. A pretty decent month with reported overall growth, and they also led all industries in employment growth. But there was a comment from one of the respondents that steel, and aluminum tariffs might have an impact there. I just want to add that your predecessor, Tony Nieves, he always said he used to joke with Tim Fiore on the manufacturing side. He used to say, when construction is doing well, it's a services industry. But when construction is struggling, it's a manufacturing industry.
Very
well,
good.
Well, for the report, it's always, for the report on business, it's always a services industry. But I thought I was reminded of that little joke that Tony had. But just talk about, construction and the month that it had, and just, evaluate, that industry a little bit.
Yeah. So when we look at the commodities month over month that we're seeing the pressure here. Let's look that up real quick. So we've got aluminum products, copper-based products, steel and steel products, and HVAC. Any of that sound familiar when you're building a house or doing construction work? So definitely an impact there. I think the tariffs coming in are going to continue to escalate costs there. I think I don't have a crystal ball on the Fed. There are many smarter people than me, analyzing numbers across a wide swath of indicators. But my conclusion from this month's report is there isn't anything that says we should see a rate cut soon. We know that the mortgage rates are not coming down as hoped with the initial rate cuts this year. So I think of anybody, you look at utilities and you look at construction, they're the ones that I would have the most concern for, because we're definitely going to see issues with lumber, with steel, with aluminum, with electrical components, that type of thing going into the cost of services. Construction folks may hope that they'll be able to pass that along to the customer, but mortgage rates and financing costs are not making room for those increases. So I think those will be two tough markets.
Yeah. We've talked about this a little bit. I think it's a good kind of off ramp to take on because you've discussed these dynamics a lot, not only today, but in previous months. Tim Fiore has as well. More so this time around than in the first Trump administration, the Biden administration had their share of tariffs too. I've not heard, as much chatter about companies and suppliers having a little kerfuffle about which party is going to pay the tariff. I mean, I didn't hear that a lot in the first Trump administration or in previous tariffs, and that seems to be coming up a lot now. As someone who's been in that arena a lot and has had to do a lot of that, is there any risk of a hit to the business relationship because of that? And how does a company and a supplier and a buyer kind of navigate that disagreement or uncertainty right now?
Yeah, it's certainly a very large encouragement to not single source, or not sole source. Sorry, you want a multi-source so that you have some flexibility. And the idea was that having a secondary source in Mexico, Mexico is going to help the issue versus China, or Vietnam versus China, and all of that is we're seeing significant hits kind of across the board, at least what was on the chart yesterday. I think that the relative size of the companies will have a big impact in that, and absolutely it's going to impact the relationship. Where there's a very transactional relationship, there's going to be no interest in shouldering the cost on either side, and then it's down to what opportunities do you have to sell, or what opportunities do you have to buy that's not from your incumbent. And the good news is, from a sourcing perspective, we're going to be really busy. So a lot of interesting. I don't know that that's good news, but there'll be a lot of activity there because when you have a credible competitor to an existing supplier, they're willing to figure out a way to make it work, and they're not looking to take their net margin from 9 to 11 or from 22 to 23%. They're looking to win business that they don't have today. And so I think when you talk about impact to the relationship, I mean, that's the kind of discussion I would be having with suppliers is, when inflation rates went down, we continued to pay. We continued to pay our cost escalations. And so now it's your turn.
Mm-hmm.
If are we in this together or aren't we in it together? And hopefully you can work out a win-win where there's a cost sharing. But I think there's going to be a lot of competitive activity that's going to terminate some relationships, and is going to really show who your partners are, both on a customer side as well as on a supplier side. It's just an overlay cost at the end of the day. Now the question, is it inflationary? Depends on how much money there is in the system.
Yeah.
If I've got $100 to spend, it's not going to be inflationary. I'm going to buy $100 worth of stuff. I'm not going to spend 110. And consumer debt has skyrocketed. I think this is a couple months old. I think it was the highest credit card debt that we've ever seen before. I don't know where it is today. I haven't been keeping that close a track on it. But on the consumer side, I don't see the ability to pass through the increases.
Right.
They'll just, do they want to continue to increase revenues, or are they more concerned about managing their profit margin?
Yeah. I was just reminded as you were talking, we had ISM has asked a lot of survey questions about it, asking companies, are they able to pass the, cost onto their customers? And, maybe they're a little interested in earlier in the chain having that dynamic happen. So yeah,
absolutely.
Why that's happening. Yeah. Well, you mentioned that, we lack a crystal ball, but it's that time of, as we're approaching our last third of where we kind of think a little bit big picture. And, I'm just reminded, I've reminded you a couple of times previously about it. You had a quote in the economic outlook story that I wrote in the January-February issue of Inside Supply Management, our annual economic outlook that is getting more profound by the month to me. You talked about a shock to the system and how there isn't a whole lot of cushion in case we had something like that happen. And what happened yesterday might qualify. I think a lot of people would say that it has great potential to. Just based on that outlook, what kind of cushion are we looking at, and is it in danger? Based on what's going on, with tariffs and other trade instability.
Yeah, Dan, I think we've got a pig that's 1/3 of the way through the snake at the moment. The people that have well-established, sophisticated supply management folks, they took positions on inventory. They accelerated delivery of product that they wanted to get in, so they didn't get impacted as much with tariffs. We're going to move to kind of the middle of the snake, I think, next month or in April, where more are going, oh, wow, we gotta figure this out. And they're going to be figuring it out for 2 or 3 months. And then we'll have the laggards next month who will come in and they'll be trying to figure out, okay, now all these dynamics are happening. Suppliers are coming in with price increases and they're not willing to negotiate them. What do we do? And then 2 months of gyrations around what tariffs really happen versus don't. I think all of that will impact new orders and it'll impact employment. I think we're set to see employment number creep down a little bit more. I think we're set to see the Services PMI go into contraction territory slightly. I wouldn't expect it to go below 48, but I wouldn't be surprised if there's a combined across business activity, new orders, employment, and supplier deliveries where we see the numbers, come down 0.5 point each to drive us. Well, I guess that'd be about 1 point each to get a Services PMI that's below 50. That seems very conceivable for me, given the level of uncertainty that's out there.
Yeah. Well, this is one of those, before I, ask if there's anything that we haven't discussed or talked about that, or that I haven't asked that you think is important. But this is I guess you could qualify this as as a philosophical question, but I think it's relevant considering what we're seeing. Tim Fiore in Tuesday's broadcast had a comment to this effect, and I've heard it from other people that I've talked to as well. It's a dynamic that I'm really interested in and might be written about in Inside Supply Management soon. I wanted to get your thoughts on it as someone who's involved in it. If the Trump administration has made it clear that these kind of protectionist policies are the direction that we're going in, there's sentiment out there that we're all going to have to come to a consensus, from consumers to CEOs, that things are going to cost more and companies are going to have to pay more, pay their employees more. Is that sentiment that, you can kind of see and agree with, or, just what you're, and do you think that, how will consumers and companies swallow that, if that's the direction that we're going?
Yeah. Supply and demand, it's going to come down to supply and demand, not only goods and services, but money supply. I'm not seeing this flow through in general to, at least not the numbers that we saw this month, if they continue kind of in the same trajectory. There's only so much money to go around, so many goods and services to be consumed with that money. That means some people are going to be losing business, which means the people that are doing that work are not going to have jobs. And then to the extent that we're able to negotiate away those tariff impacts, either through alternative suppliers or through just settlements between the governments and where those tariffs go in, then I think everybody wins at that point. The big issue here is really, I think, on a supply management side, going back to the thing that you said earlier, and that impact to relationship is, don't be reticent to engage your CEOs or your CFOs or other business leaders in your negotiations with suppliers, because there's uncertainty here as to what happens with business. If costs go up, there's going to be less sales in terms of units, because there's only so much money to go around, and I don't see the Fed releasing or relaxing monetary policy at all. So in that case, there's uncertainty around demand, either by you switching suppliers or by just overall demand going down. Business leaders in the selling companies, in your suppliers, will be interested in capturing business and securing business for the longer term. And if you can convince them and be true to your word that they're a critical supplier and you're going to continue to use them for a while, I think they'll be inclined to burden that hit to their P&L and try and figure out where to get it otherwise, knowing that they don't have the risk of losing your business if you're a key supplier and a key customer.
Yeah. Well, we got about a minute left. I mean, I always like to give you this opportunity. Anything that I didn't ask or anything that we haven't talked about, that you think might be important to include this month?
I'll just emphasize something that you gave me the opportunity to talk about earlier, is monetary policy. I don't think we should be expecting to see relaxation and what our cost of capital is. So when we're looking at projects, whether they're capital projects or whether they're large system implementations or that type of thing, we're going to be very important to those discussions to manage costs in a way that they're affordable and we can generate the ROI with a higher cost of capital. So I think that's an important thing for us to have in mind as we're looking at getting project approval and how well we partner with suppliers to deliver the right economics.
Yeah. Well, it will be a most interesting couple of months coming up. I'll look forward to discussing the fallout with you next month on this broadcast. But
the Chinese curse, may you live in interesting times.
Absolutely.
We're in interesting times.
They certainly are. Well, hey, we hope you enjoyed our discussion on these interesting times, and I would imagine that they're going to get more interesting as the months go on. Thanks for joining us. For more information, feel free to go to ismworld.org, where in a little bit you can read our roundup article that just details a lot of what Steve and I just discussed here. And if you want to be part of the ISM Manufacturing Services or Hospital Business Survey panels that help compile data for the report on business, join ismworld.org. Go to ismworld.org/join the panel for more information. We'll see you back here in a month's time. And yep, we expect it to be interesting when we break down the April ISM report on business. So for Steve Miller and some good folks who helped us behind the scenes, their names are Christina Cahill and Jennifer Stevens. My name is Dan Zeiger. We'll see you next time.